President of the European Tax Advisors Federation, ETAF. It is a great honor for me to welcome you today to our conference on stable recovery through fair taxation. What a topic, isn't it? It's a moment all the more appreciable as it is our first physical conference after the pandemic, and we tried to do it, and thank you for you to be with us today in the room. And it's so good to see all you seated in this room. And we have many tax advisors in Europe connected online in many member states with simultaneous translation in their own language. So welcome to all of you connected in all Europe. Don't forget that the COVID-19 pandemic is unfortunately not yet completely behind us, and we still have to face the consequences on our lives and on our economies. Our governments launched one relief measures after the other and released billions and billions in aid programs. Tax advisors were at the forefront to help small and medium-sized business to navigate through all the relief efforts by the states. Altogether, the European countries borrowed money to recover from the pandemic through the Next Generation EU, but let's not forget that we will have to repay it. For our point of view, this stable recovery, which is so badly needed, can only be done through a fair taxation. This is important for tax acceptance. This is even more crucial for tax compliance. And this is exactly what the European Commission proposed in its action plan on 15th of July 2020, which contains a set of 25 measures aimed to reduce tax obstacles for businesses, better fight fraud, and promote compliance with taxpayers. And again, almost a year after the publication of the action plan, the Commission published a communication on business taxation for the 21st century. It announced several measures, such as a legislative proposal to go after shell companies, a legislative proposal for the publication of effective tax rates paid by large companies, and also a new framework for income taxation, the BEFIT. The European Parliament also created its own subcommittee on tax matters, which recently turned 1 year old and is very much committed to make recommendations and trigger a debate on the fairer tax system. And we have the honor today to welcome Paul Tang, its chairman. Thank you, Paul, for being with us. There is now a clear momentum for fair taxation, because no more than ever, governments can't afford to lose billions of euros each year to tax fraud, evasion, and avoidance. And yet, the latest tax evasion scandal revealed by the Pandora Papers investigation just last week is another reminder that the EU still has to do more. Regarding professional law, for ETAF, an EU-wide legal obligation of tax compliance for tax advisors could make significant contributions towards avoiding tax evasion. We believe that our profession, the tax advisors, can and should assume an important bridging function between the taxpayers and the tax authorities, and hence make a significant contribution to securing the tax revenues on the member states. But the high quality of tax advisor services and their best possible education and training do also play a very important role. And here we can see that in Europe, the spectrum ranges from full liberalization in some member states, such as the Netherlands, up to high level of regulation in other member states, like in Germany, France, and Austria, etc. In the member states in which the profession is regulated, tax advisors are legally obliged to practice their profession conscientiously, diligently and in full compliance with all applicable laws. ETAF members went a step further by signing in 2020 a charter of regulated European tax advisors that serves as a code of conduct for tax professionals. It outlines basic principles in tax concerning the role and statutes of regulated tax advisors in the tax collecting process, lays down guidelines in the exercise of the profession, and introduce appropriate control measures. We will keep advocating for a European approach on this, and we truly think that tax advisors who are themselves legally obliged to fully comply with all applicable tax laws at EU level could certainly help strengthening the tax compliance in our societies and thus contribute to a fair taxation. Regarding the global tax deal, what is the topic today? When we speak about fair taxation, we don't think only about the fight against tax abuses, but also about having tax rules that are fit for purposes. Globalization and digitalization have fundamentally changed our economies and created new challenges for our tax system. The current rules of the international tax system are now a century old, and they are not fit for today's economy. It is high time that everyone pays its fair share of taxes, and especially digital companies who are the big winners of the COVID-19 pandemic. We are even more delighted to welcome you today for this discussion, as the G20 is expected to endorse tomorrow in Washington the historical agreement on the reform of the international corporate tax system. Well, what is the update with the results meeting inclusive framework of last Friday, the 8th of October? The agreement on Pillar 1 means that all participating countries which have a national digital levy in place will have to put it on hold and commit to what has been agreed at OECD level. ETAF welcomes this idea very much, as it makes sense to have a unified and global approach. I would like to mention that ETAF has been a precursor in this matter. Already in 2016, ETAF presented a white paper to Commissioner Moscovici about precisely this topic. At that time, only very few people understood the dimension of digitalization and how important it was to shape a fiscal policy that accurately tackled this issue. ETAF has also pushed for and welcomes the agreement on Pillar 2, as it will stop the race to the bottom with respect to corporate tax rates, and it will thus contribute to a fairer distribution of tax revenues and a fairer tax system. So, coming to our conference of today and our speakers, ladies and gentlemen, with this conference, we want to launch a debate and reflect together about what will be the post-pandemic tax world. Will it be really a fair one? And what role will tax advisors play in it? To address these questions, we are delighted to have with us a great panel of high-level speakers. Let me welcome Aurore Mons Roche, en français. C'est italien, no? Delle Rocche. No? Okay. She's tax partner at EY and member of the ITAA Council, who will represent regulated tax professions' point of view in today's debate, and many tax advisors in the room wait for you and count on you. Benjamin Angel from the DG Taxe of the European Commission will update us on the work currently on the table on the European Commission to realize its action plan for fair taxation. And last but not least, the MEP Paul Tang is also with us today, and we will love to hear him from what the FISC subcommittee that he's chairing has on its plate too. I now leave the floor to our moderator, Elodie Lehmer, journalist for the famous Belgian newspaper Le Soir, who has been covering EU tax policies in Brussels for many years. So many thanks, Elodie, for your contribution. And now it's your task.
Hi, yeah. Can you hear me well? Yeah? That's the issue with my last name, actually. It used to be a problem when I was a kid, and now it's even more a problem when I speak with English-speaking people, because it's la mer, not lamer. I don't really like the lamer. When I thought about this conference this morning, I was happy because, I mean, the timing is quite great, because we have this global tax deal, and the G20 is meeting tomorrow, but we also had this Pandora papers, I will manage to say it, leaks, which every time there's a new scandal, you're like, oh my God, we missed something in fixing the tax rules. So I guess it's a really, really good timing. I must say that we tax journalists have a few laughing issues between us, and it's usually behind the Commission's back, because we always think, you know, FTT, CCCTB, and also the global tax deal. I mean, we were sure that we would never see it happen. And the sad bit is that for the EU, who's been pushing it for many years, nobody will remember that actually the US blocked it for many years. Everyone will remember that it happened in the end thanks to the US. So I guess every one of us who grew up with with sister and brother will know the feeling. I certainly do. So, without further ado, I would like to know, to all speakers, and maybe starting with Paul Tang, who we should say happy anniversary for the first year of Fisc Committee. Can you tell us, is this global tax deal a really revolution towards a fairer tax system or not?
Well, I think it's a great achievement. And in a sense, if you would have asked me a year ago, before the election campaign in the US, I would not have been sure that the deal was within reach. And to come to think of that, we strike in these days a multilateral deal is also something I think we see the polarization in our world, in our society, but also across countries. Fight among superpowers, and then to come to a deal which brings all the important players on board is exceptional. So that's a real achievement. And yeah, I very much hope that and think that it will change the corporate tax system. We had a race to the bottom. Now there's a bottom. But of course, the proof's in the eating of the pudding, because what we need to have is that it indeed stops this race to the bottom and also allows countries indeed to raise the corporate tax rate. Right? That's the whole idea, that we restore their sovereignty. They had only one option before, that was going down. Now they have two options, going down or going up. And the proof of the proof is in the eating of the pudding. I will be happy to see that the member states, the countries that will raise the corporate tax rate, because let's face it, 50% on a corporate income is not significant if you compare it to personal income. Mm-hmm. It will lead to incorporation of persons, right? So that's the tendency we have seen in the past years. But that was the aim also, of course, of the Biden administration. The Biden administration wanted to invest not only in the recovery but also in infrastructure, and needed therefore to raise taxes. In that sense, we are also entering a new era where I hope with new thinking that we see it's not about taxation, it's about the public goods that we need, the collective goods that we need, and there are quite many on the table. And of course, the first that comes to mind is fighting climate change, where we need huge investment from private and public sector. In that sense, I very much hope that this is also a sign that we stepped into a new era where we dare to have the collective actions delivered by international agreements and national governments, and that need to be financed by efficient and fair taxation.
Thank you.
The same question.
Yeah, the same question.
Okay. So yes, I think indeed that this is really a revolution, or at least it is historic, we can say that, and it's impressive to see that yeah, 136 countries agree on that. So on that agreement. So it's really impressive. Also, if we think about when the inclusive framework was created, it was only in 2016. So basically, in 5 years, we get that agreement. It's amazing. I think on the principle, we all agree this is a great achievement. As you said, this is the end of the race for the bottom rate. This is also very important because this tackled the issue of the digitalization of the economy, and that was really important to find a solution. And honestly, from on my side, I was surprised that we could reach that agreement as fast as we did. So on the principle, it's really a great thing. No, there are a lot of challenge, I think, for the tax accountant and the tax advisor in general, but also for the enterprise to make sure that they are compliant and to make sure that everything can be tackled, because it's a lot of work, I think, for all the taxpayers and also for the tax advisor, which is a good thing. We all agree with that, but still, I think we still need to have more clarity on many of the rules, and we need to make sure that it is applied the same way everywhere, and that there won't be too much problem in terms of interpretation and that kind of thing. So that's really, I think, the big challenge, but it's a challenge we are happy to take, I think.
Benjamin?
Thank you. It's indeed a major milestone. I fully agree with Paul and Aurore. Obviously, the situation is a bit different today between the two pillars. On Pillar 2, we have managed with some difficulty to get to an agreement, and we, European, had also a lot of homework, since it is in our geographic constituencies that some concerns had been expressed by some member states. So in the last week, we have invested a lot in discussion with the member states concerned to make sure that we find a deal which is acceptable for them. It was a difficult discussion because the starting point was also different for some states. Some were clearly after setting a minimum to the competition on taxation, and therefore having a minimum applicable to everyone as a bottom. Some other were rather seeing Pillar 2 as a leftover of the BEPS discussion, where we should go after artificial arrangement. And that explains very much the discussion which has taken the most time in the finishing line, which was the discussion of the so-called substance carve-out, because the countries which saw Pillar 2 as a leftover for BEPS were of the view that we need to have a very high substance carve-out for activity which are legitimate, which are physically present in the state, for which it's clear there's nothing artificial, it's just there. While countries which were, on the contrary, looking for slowing down international tax competition and having a a minimum limit, were rather aiming at having a substance carve-out as low as possible for the opposite reason. So we needed to fine-tune between those two groups, and I think the result which have been obtained is relatively satisfactory for everyone. On Pillar 1, Pillar 1 started because of digital. Very clearly, the Europeans were after a better connection between the physical presence and the taxation. That's a difficulty with the digital sector. You can have a presence anywhere in the world and do your business on the whole planet. Our tax system are very poorly equipped so far to address it. It has changed of nature along the way. And it's fair to say that the orientation on the request from the Biden administration makes Pillar 1 a different animal than the one which we had in mind initially. It's hardly digital. If you look at the companies which are in scope, we have something like 5 or 6% of companies which are in the digital sector. It has become something which de facto covers almost all sectors except the financial sector and the extractive industries. It's just a new modality now to share a taxable base between countries where multinationals operate. It's quite an intellectual revolution when you think about it. Imagine, for instance, that Airbus would become one day in scope. Today it's not profitable enough, unfortunately. But if it were in scope, it does mean that the country which sells Airbus, so France, Germany, would need to share the taxable base with the country where the companies purchase the planes. It's a completely different approach. Well, everyone can see the logic for digital. When you're talking of physical industries, it's quite revolutionary. And the difficulty was to have all countries on board, including the smallest one. And that explained also the choice to go for a very, very, very low nexus. Because for the majority of countries around the world, the nexus is only 250,000 euro. So the minute you have 250,000 euro, you get a distribution of taxable base, which is very, very low. And certainly complex to implement, so you will have a lot of activity, I have no doubt.
You insisted a lot on the fact that digital is not like the big focus on the first pillar, which was like the aim of the Europeans at first. And your task now will be to introduce everything into EU law, propose legislation. And I mean, hearing you, I'm thinking, you know, what everyone is thinking. What are you going to do with this digital levy proposal that is due in the coming week, is in the autumn?
The Commission has promised to the Parliament that it will table a proposal on own resources before the end of the year. There are some components which are relatively clear and stable, like having a carbon border adjustment mechanism, where we already have the legislation on the table, the extension of the emission trading scheme. As regards the corporate element, we are still discussing. Mm-hmm. So you'll have to be a bit more patient.
And what about the implementation of the two pillars? Do you have any kind of calendar? Do we need a directive for each of the pillar, and how? What is your view on how it's going to be done?
We absolutely need a directive for Pillar 2. It's very clear that implementing Pillar 2 without a directive would create a very high risk of inconsistency with union law and ECJ jurisprudence. Mm-hmm. This directive will have to stay as close as possible from the OECD agreement, but there is at least one inflection which is needed from a union law point of view, which is we cannot distinguish between a domestic and a cross-border situation. As you can imagine, for anyone familiar with union law, the very concept that you would tax more the multinational of another member state than your own multinational is an immediate no-go from an EU law point of view. So that needs to be adjusted. For the rest, we'll try our best to stick as much as possible to the agreement. We're working on a transposition which is as quick as possible. We still wait for the OECD model rules. The OECD model rules are supposed to be finalized by the end of December. I think there is already a substantial chunk on the table. We have already a draft directive which we keep updated depending on the evolution of the technical element. Our hope is to be able to table a proposal by the end of the year, this year, for Pillar 2. Mm-hmm. Yes. For Pillar 1, the calendar is very different for two reasons. The first reason is that much still needs to be agreed on. Pillar 1, we're relatively short of detail at the moment, so there's a lot of technical work that still needs to be made at OECD level. I think the agreement will give a political impetus to this work, so I have no doubts that it will be finalized on time. But for Pillar 1, we need also a multilateral convention. That's a big difference with Pillar 2. Pillar 1 will be an international convention that will be ratified. Mm-hmm. So most likely, we need also to see the fine print of this convention and take a decision on whether a directive is needed or not. While it is self-evident that we need a directive for Pillar 2, we are still looking into it for Pillar 1, where it's a little bit more nuanced, if only because our member state will ratify an international convention, which is obviously binding on them.
And staying on Pillar 2, maybe to Paul Tang, you mentioned the 15% rate. I mean, in the last days of negotiation, the terms at least 15% were removed, do you think that it really weakens the text, and do you think that 15% is enough?
Well, I already tried to make clear that I think 15% is the starting point, but it will come hopefully in later rounds, that we have a framework now in place that allows us to update over time. Because that's coming back to one other issue. It's not just the 15%. Also, it started indeed the discussion in the OECD on the taxation of the digital economy. It was the first action plan in the BEPS action plan. I remember very much Bruno Le Maire campaigning for a tax on the GAFA. Well, see what we got. Not a tax on the GAFA, not taxation in digital economy. And that's at pillar one is, well, let's say interesting because we have the destination principle now enshrined, but it doesn't really address the unfairness that politicians like Bruno Le Maire felt that the largest companies in the world with the highest profit margins hardly pay any taxes, and that we don't address in general the taxation in the digitalized economy. So that leaves, besides the European Parliament very much wanted to see, and not just the European Parliament, to have a digital levy. It was in the conclusions by the government leaders in June 2020 as an own resource. That's now off the table. So, like I said, I started what is a great achievement. It is, but of course there are some critical points, and I think we need to address these points over time as well. And this won't be the last of discussion. Can I say just one thing? Because we are here in a group, in a setting where we are with experts. What I find always concerning, but as a politician, that the democratic involvement of the democratic institutions don't seem to work. This was done like a 19th century deal, in all fairness. The good thing, of course, that there was the corporate lobby was limited. Usually in taxation, corporate taxation, there's a lobby involved from corporates that was absent. That's the upside. The downside is that the general public and the general politics is not involved. And as far as on these critical issues like taxation of the digitalized economy and especially the big tech, yeah, I think there are strong public and political feelings that this should have been addressed in this. And this is what we need to also learn in this process. We need much better involvement from I would say, of course, the European Parliament, goes without saying. But from national parliaments, but also from public interest groups, that we have a bit of a process, and that of course involves the tax advisors. So that we've come up with a process that leads to well, a result that has support politically and publicly, because and that's why we need to update this system again and again. But let's hope that this framework has been such that we can have a continuing debate and an update every 5 years. That would be wonderful.
Mm-hmm. Aurore, you want to add something?
Just maybe a reaction. You are saying that 15 is maybe not enough. But if you think about it, this is an effective tax rate, so it's not the nominal tax rate, and this is something which is not always understood in the public, I think, because you say, 15, but in Belgium, you know, the corporate tax rate is 25, so 15 is much less. Yeah, but no, because it's the effective tax rate, so it's after deduction of cost, etc. So I think it's just knowing that, I think it's not that bad, 15%.
That's you don't find effective 50% not that bad, you say. But it's because you compare it with zero. And this is not this is not a comparison, I think that's fair. You need to compare it to an income tax. It doesn't really matter where the income is derived from profit or for labor. You treat the same income, similar income from different sources should be taxed the same way. Otherwise it leads to a corporation of persons. So there's always a link between the income, okay, fine. So I don't compare it to zero. That would be a false start of. But you're right, compared to zero, it's absolutely fine.
Mm. And I don't know how many of you will remember the directive on cross-border merger and transfer of seats. And I remember this directive, nobody would want to read it with this title. But when you look at it, it was about abusive relocation for social or tax reasons. And I remember that in this discussion, the legal service of EU institutions were like, you cannot tell companies that they cannot move from one country to the other because they want to have better tax treatment. That's against the four freedoms of movement. And I think that the same issue actually arose in the second pillar. So, I mean, is there any concern that without an abuse as such, setting a minimum tax rate would be against EU freedoms?
That's why we need an EU law text. It's very clear that if member states were to implement it on their own without the backing of union law, there will be a high probability that the measures are cancelled by a court. We have a set of jurisprudence, I think many will remember Cadbury Schweppes and some other jurisprudence of this kind, which make it difficult to go after this distinction. And that is also one of the reasons why the directive will not distinguish between domestic and cross-border, because that would prevent any possible accusation of discrimination between a national and a non-national. Now, as regards the rate, if I can make a comment, I would agree with Aurore that 15% is not that bad, honestly. Talking about an effective tax rate, you will not find a single way of computing what the situation is today in the member state, but roughly speaking, 1/3 of our member state were more or less below 15%, 1/3. And we are not talking here of exotic Caribbean island. Huh? We're really talking of member states. So having this floor at an effective level is demanding for a number of member states. Paul is right, obviously, that we have seen in the last decade a tendency where the share of the corporate income tax in the financing of the state has gone down year after year, and when the rates have gone down. So at least we put a limit to this competition. And I guess it's in everyone's benefit, because we hear sometimes the NGOs being very critical and saying, oh, this agreement, it's benefit only the large states, those who have seats, etc. If you're a small Caribbean island, you have a 5% rate, your neighbor goes to 0%, you're under very tough pressure to go for 0. So by setting this international floor, we're also protecting some countries from this pressure. And this pressure today is not strong on states like Germany or France or the United Kingdom, which can afford having rates at 25, 26, 27 and still be attractive. This pressure is strong precisely on the poorest state, the one that have little to offer. And by putting this floor, we ensure that also those poorer states get the tax income they need.
And I mean, Poland was one of the countries that said on Friday that they would keep working on this. So we're not exactly sure where they stand on this second pillar. Are you confident?
I think you're mistaken. Poland has joined the Inclusive Framework Agreement.
Okay, so you're confident that
all member states, well, 26 out of 27 formally join the agreement. But the one which has not joined formally the agreement did not oppose the agreement as such. It was just not a member of the inclusive framework. It's Cyprus, because when the inclusive framework started, Turkey opposed Cyprus participation. But we are confident that the 27 member states in practice support what has been decided, and that we will not be facing particular difficulty when coming up with the transposition of Pillar 2.
Okay. And maybe to Aurore, there was this whole question of carve-outs, without maybe getting into too many details. Can you explain, I mean, for you to try and advise companies on this, I mean, do you see how you're going to do this? Is this going to add more complexity to the thing?
Sometimes it depends on what carve-out you are talking about. If you are talking about the carve-out for the financial sector, for instance, it's easy. The financial sector is not impacted by Pillar 1, for instance. That's an easy one. If you take, for instance, the substance carve-out in the Pillar 2, there it might be much more complex, and it will require much more data to be gathered to be able to make sure that the taxpayer or the corporate or the group can benefit from it. So it's there is, like, for the whole Pillar 2, actually there is a data challenge that needs to be managed by taxpayer. So it's a good thing because to have that carve-out. I think it can help many groups. It's a good thing, but it's not simplifying thing, so to say it like that. But it's good. Now, coming back to the financial sector, for instance, there we see that there is a carve-out for the assets, tangible assets, and for the people. The percentage which can be deducted is based on your assets and on your people. For instance, in the financial sector, there are not so much assets compared to the rest of the balance sheet, so it might be not as benefit as for other industry, and there might be, we're still wondering whether all the industry will be treated the same using that carve-out. I know this was one of the concerns that was raised, and that's the reason why there are two elements which are taken into consideration: the tangible assets and the people. But still, if you compare I don't know, a group which is active in the chemistry with a financial service group, then you might have a big difference. And the question was there, why don't we take into account regulatory capital of that kind of thing? I'm wondering whether that substance actually carve-out could not be completed or could be improved, but maybe after a certain period when we see how it works with the rule. I don't know.
How are you preparing for this? I mean, are you hearing a lot of companies saying that they have a lot of concerns that this is too complex and that they won't be able to adapt?
Actually, the complexity, it's much different from one taxpayer to the other. It really depends. If you take Pillar 2, and I will speak about Pillar 2 first because it's the more concrete now. But on Pillar 2, it really depends on the system, the financial data available, how the finance function is organized. It depends on many different things, but the complexity can be very different from one group to the other. That's an important thing. For the moment, clients are just, they didn't really look at it deeply. They're just, getting information, trying to understand. And as a tax advisor, what we do is to try to focus on the most important part of Pillar 2 to explain, this is the thing you need to consider. This is how you may be impacted. Mind, for instance, your pre-regime tax losses, because what would happen with those afterwards, that may be a point of attention. And that's how we try to approach the thing for the moment. And we are also starting to make some simulation also based on the CBCR reporting, just to see what it gives, but that's not the end product yet. And we don't have it's not really fine. It's not accurate yet, but still it gives some idea. And that's where we are. But I must say, for the moment, I won't say that the clients were in denial, but that was not the first priority, but it's because there are so many other set of rules which are developed for the moment, and I think they are trying to work on stabilized rule. That's a very important one.
The Commission is planning a BFIT proposal in a few years, 2023, if I'm not mistaken. How is this going to fit in the whole reform of the global tax deal, and how is it going to be complementary to the OECD rules?
We don't have the details of BFIT. We have announced the direction, the journey, the calendar. but we want a different process than the one we traditionally have on EU files. Normally, the Commission works on its own, prepares a proposal, consult a bit, and then the discussion with member states start. I think that if we follow the traditional approach, BFIT will not go anywhere. It will be just a repetition of what we have experienced with the CCCTB, where we have been running in circles for the last 10 years. We got some applause from the European Parliament, some interest from business association, but we never got ownership from member state. And it was becoming some kind of running joke where each presidency was organizing in the last 2 weeks of its presidency 1 hour session to be able to say that the discussion has continued under its presidency. So we just take our losses. The Commission has announced that he will withdraw the CCCTB. And we will work as soon as the OECD work is over with member states and stakeholders on co-designing BFIT. We want working group where member states are actively involved, where they can influence the animal that we are creating before anything is put on the table. And it's only when we will have sufficient confidence that there is a product which is acceptable for member states, then we will shoot an effective proposal. Mm-hmm. Now the articulation with Pillar 1 and Pillar 2, well, first it will depend obviously on what is put in this proposal, which we don't know at this stage. But I think intellectually, member states have done 2 important steps. With Pillar 1, they have accepted the principle of mechanisms to apportion a taxable base between countries. And that was, as you can remember, one of the key elements also in the CCTB. And with Pillar 2, they have accepted also some common principle on how to calculate the tax rate and what should be part of the tax base. So there are elements on which we can build on. And I think that this psychological step should not be underestimated, because clearly when the discussion started on the CCCTB, it wasn't there. Mm-hmm. And few would have hoped for a global agreement to be reached. You really have to understand how revolutionary it is. You know how difficult it is to have an agreement between 27 member states. Imagine what it means between 136 countries of all size and economic influence. And yet, it was made.
And if we draw lessons from the implementation of BEPS into EU law, I mean, we've always been a bit further than what was actually agreed at OECD level, and the Parliament has been like a strong pusher to this. Do you see any leeway for you, for the Parliament to just push the Council and ministers to agree on stronger rules than what was agreed at OECD level on the global tax deal?
Well, we always try. Not sure that we're always successful, though. Can I come back also to the BFIT, because sure. I was involved in the CCTB. I find it very interesting that the Commission is starting a different process. I think that's that could be very helpful. My experience with the CCCTB was that there was a sort of odd coalition possible between big corporates and NGOs, because they could all agree on consolidation. There was a principle many of the large corporates and the NGOs could unite on. And so that could also be one of the make the process a bit broader, not just the ministries of finance or taxation on the table, but broaden it to include the large corporates and the NGOs at the same time. It will be an interesting process. And my best bet would be that it would it could be a constructive dialogue to go forward. On this matter, of course, when we have the Parliament will try to push further, but I think there's also one important element coming up, which I think is also very much put in light again by the Pandora Papers. Is also the shell companies, for example, where we're eagerly awaiting the initiative from the Commission. And what I also find very interesting is that you see some changes, not just, indeed, Benjamin is absolutely right, there are important principles in the OECD agreement that will help to benefit the European discussion, but you see also some of the member states accepting that, for example, that shell companies should put, well, big bans or limited, even in the usual suspects, I may add. I don't expect huge resistance from Luxembourg, but I also find very interesting that, of course, that the Netherlands is really changing. So I very much hope now that we have that we are able to form a new government. But in any new government, there will be a hard line on fighting tax avoidance, which is very. So you see, the tide is also changing, and that works to our advantage. And the European Parliament will, of course, try to contribute to that. But are positive signals.
And to try to make the link with the second discussion that we will have now on tax transparency, I mean, with this global tax deal and this minimum rate, if I'm optimistic, I would say that maybe it is the end of tax havens in the whole wide world, because it wouldn't make any sense to hide money anywhere because you can be taxed. So, I mean, do you all believe that this introduction of the minimum rate should be a criteria for the blacklist, the EU blacklist of non-comparative?
From Parliament side, that's simple. That's already in our resolution, yes, that we want better criteria. But let's see what the others think.
Yeah, I think it's very important to eliminate all the tax haven on this planet. That would make the life of the tax authorities, but also the life of the tax advisor easier. Yeah, no, but it's true somehow. Yeah, I think it's indeed a good step forward, and also the fact, because then you have the tax haven, but you have also different kind of structure that may be put in place to avoid or to limit tax. And there, I think tax transparency, as you said, there are a lot of initiatives there as well, and this is also a very positive thing. But again, this is also new reporting and new thing to do, new thing to produce for tax advisor. And there the question is, how can we make sure that it remains sustainable also in terms of work and reporting? How can we do to make sure that those reporting are streamlined and that it is easy to do? But maybe we can come back on that on the second topic.
I think the agreement is definitely a major blow for tax haven. The question is whether, as a standalone, it's enough to terminate tax haven as such. There one has to be probably a little bit more nuanced. Pillar 2 is revolutionary, but it applies to groups having a turnover above 750 million euros, so only the biggest. So for instance, you could very well have tax haven that's specialized somehow in hiding private wealth from rich individuals. This is not at all captured in Pillar 2, to give you an example, or other forms. So we need somehow to complement the action of Pillar 2, which is already very powerful, and which will help endangering the business model of zero tax jurisdiction country. There are many, we still have dozens in the world, and not necessarily in exotic Caribbean islands. Huh? As you know, Jersey, Guernsey, they are zero tax. United Arab Emirates, zero tax. So sometimes we have country of importance in this category, but it's not enough. And that is certainly one of the lessons also to draw from Pandora, and make the same mistake as yours.
Yeah,
the Pandora scandal. We need other actions that complement already the very positive effect that Pillar 2 will have on limiting this kind of abusive and aggressive practices.
You wanted to add something?
Yeah, just wanted to add something. That's true that we are only tackling the big corporate and that for the smaller one, yeah, there is nothing yet. But still, I think there is also a change in the mentality. If you look also all what we say today, the growing concern about ESG and sustainable finance and that kind of thing, it's much more and more important for taxpayer and corporate taxpayer as well, even if they are not the big one, to make sure that they have that they are sustainable from a tax perspective as well, that they have the good governance with respect to that, and that they have a tax strategy which fits with all those concepts today, and that's also an incentive, I think, which is quite important for investors also to decide whether they would invest in that kind of company or not. So it's also a new incentive, I think, to make sure that the behavior of taxpayer improves.
Can I just one point?
Sure.
Just one point, because Aurore gave me an occasion to mention that we plan to accompany our transposition of Pillar 2 with another directive, which will come the same day, which is a directive which will mandate for companies in scope of Pillar 2 transparency on the effective tax rate paid on a jurisdiction per jurisdiction basis. So the content of the directive will be extremely simple, which is the effective tax rate that you have to calculate per jurisdiction, make it public. And that will help nudging good behavior, because the countries which sometimes, the companies which sometimes make use of jurisdiction where the tax rate is very low, and not necessarily because they have real economic activity or physical presence in that jurisdiction, will face questions from the public the minute you publish this.
But already today you can find a corporate group which are publishing that information, and that which are saying, yeah, or at least which are explaining where there are tax, how they are taxed, etc. So I think it's not only an evolution. It's good that actually the legislation is important, but there is also a change of mentality, I think, which we should not underestimate, also through ESG and that kind of thing, because it's more and more important for the growing generation. And
when I meet business association, I still hear a lot of grumbling about this idea of transparency, I must say. So it changes, but probably not as quickly as one would hope.
Just to come back to Pandora Papers figures, it's like every time there's a new scandal, they say that it's the biggest. So I'm guessing how many documents we will have in the next one. But it's like 12 million documents almost, 35 heads of states, and 400 public officials, almost 30,000 beneficiaries, 151 newspapers, 117 countries. We have Nikos Anastasiades, Andrew Babiš, Shakira, Whoop Opscha also. And when the same week we had this scandal, we had some countries leaving the EU blacklist, including the Seychelles. And it's funny because people spoke less about it, but Turkey was actually like the highest political. I felt like the case of Turkey was even more telling because it sounded like political interference. So there was a lot of criticism saying that the blacklist is still not has no teeth. So Paul Tang, I'm wondering, what is your opinion on this?
Yeah, the European Parliament, I think it was in February, said it was ineffective and confusing, which was all, I thought, still diplomatic terms for a political statement. But you could make say that it has no teeth. Yeah, that's true. The good thing is, of course, that it was, of course, the council made itself a laughingstock discussing the blacklist and removing the Seychelles, for example. So the good thing is that this discussion comes back, and that what we now see is some light on the discussions and the decisions by the council, which are usually go unnoticed. But a potentially very good instrument, which is the blacklist, has been squandered by the council. But hey, it's a potentially a good instrument. So let's try to work on that and improve. But this is just one of the instruments. Of course, let me start also by the public officials. You say 400. In my mind, there are 300 politicians. And I find it worrying, right? So in my comments, mainly to the Dutch media, I said, well, it's embarrassing to see that the Dutch Minister of Finance seems to rub shoulders with a mafia boss, right? This is where the upper and the underworld seem to come together in using the same services, and this taints the legitimate business and taints the legitimate democratic institutions. So that's one reason why we need to change it. And this is what I take also from the Pandora Papers, that we need to have, it shows what transparency can do, right? This can't stand the light of day, so it shows what transparency can do. It shows us how important tax transparency is. In that sense, the Pandora Papers, yeah, you can say it's another scandal, but I very much welcome this kind of work, because it helps us help our work in the Commission, in Parliament and elsewhere very much to push it forward.
Benjamin, you mentioned the transparency on effective tax rate that you plan to propose. I mean, what else is going to be part in the Commission's answer to this scandal this time?
We are working on updating actually the set of measures that we had in mind to take into account the lessons of Pandora. We already had announced before Pandora our intention to table before the end of the year a directive to tackle the issues connected to the misuse of shell companies. Not the existence of shell companies as such, because there can be perfectly legitimate reason for companies to have some dormant structure somewhere in the organization that we don't really care. But we're really talking of shell companies which are creating for having an artificial tax advantage. That's the one we are after. The set of rules we had so far in the making was exclusively oriented towards the EU. It's very good, it's very useful, it's somehow a good answer to the interesting work which has been done earlier this year by the International Consortium of Journalists on the register of beneficial ownership in Luxembourg, OpenLux. But with Pandora, it's clear that we need to go beyond. And this is what we are discussing at the moment, and see what kind of new extra rule we can bring in to help addressing to the maximum possible extent the difficulties that were encountered. It's uneasy. Some of it will have to go also via the reform of the listing and the code of conduct. Paul is right. I will naturally be less negative than Paul on the list and code of conduct. I think the glass is half full or half empty. If you focus on the negative, the sequence we had last week was dreadful. Clearly, the day the Pandora paper are published, we delist some jurisdiction which were explicitly mentioned as problematic in the Pandora paper. So you can hardly imagine a worse sequencing. At the same time, you have to keep in mind that member states have taken a decision based on existing rules. So it's not that member states have twisted the rules, they just applied the criteria as they are. And unfortunately, one of the difficulties that we have with the list today is that it follows a too legalistic approach. It's very much a tick the box. You know, you ask country, for instance, with zero taxation to introduce economic substance criteria, they change their legislation, mission accomplished. But that says very little on how they effectively implement it. And that you discover it when you have tax scandals such as Pandora. So overall, we have obtained a lot with the list. Keep in mind, it has been created in 2017, so it's still pretty recent. And we have obtained more than 140 changes of legislation in more than 60 foreign countries. I guess few would have bet on the possibility to obtain so many changes in so many countries. But the last thing we should do is show complacency. Clearly, it is not mission accomplished. There are flaws in the criteria that need to address. We need to address them. We need more attention on effectiveness. We need more attention on insufficient taxation. Today, it's not a criterion at all. and we need to come up with specific rules which address the issue of shell companies. We see the difficulty. I mean, in your profession, we have come up already with rule in DAC 6, for instance, where you have to declare artificial tax arrangement, etc. But the biggest scandal we have seen were generally not involving EU firms. Mossack Fonseca, for instance, was not an EU firm. So the difficult nut to crack for us is what can you do at European Union level to address the behavior of companies like Mossack Fonseca. Mm-hmm. That is not so easy to answer, but we're working on it.
Aurore, maybe, are you seeing any kind of change of behavior in the industry, trying to, you know, focus more on compliance than on maximizing profits for your customer?
Yeah, I think honestly that over the last 10 years and maybe over the last 20 years, but it accelerated over the last 10 years, our profession has changed a lot. I mean, we are really working more and more on compliance, make sure that the clients are paying the right amount of tax, enough but not too much also, because that's important. Yeah, if I see what we are doing, it's definitely not trying to make any kind of abuse, and or tax optimization is not the point either. It's really to be compliant, which is now the driver. No, this is even more complicated today. To be compliant, it's already a challenge, and this is what we are doing as a tax advisor. That's the main job. So it is quite challenging sometimes, because there are a lot of rules, a lot of reporting to be done, etc., to show that you are compliant. But tax optimization, to be honest, except for the very specific incentive, but which are R&D incentive or that kind of thing, we are not trying to limit tax abusively or that kind of things. That I have not seen for many years.
Mm-hmm. And Paul Tang, there will be the subcommittee will discuss a draft report by Ludek Niedermayer, I think, soon. What are the recommendations that you would like to see in it? And as a sub-question, I mean, we've had a lot of legislation changes in those tax havens, but I mean, sometimes I'm wondering if on the ground it really changed something, like concretely. Are you thinking sometimes that you should have missions over there to see, you know, meet people on the ground and see if it's just a paper
That's a good
tiger.
thought. Keep that in mind. All right, good point. Now, let's come back to the blacklist for 1 second. I try to be positive in the sense that I say it was potentially a good instrument, right? But it does need the right criteria. And the criteria are not there. It's not an effective instrument. And if we have specific demands on the shell companies to avoid aggressive tax planning, we need to have similar demands on shell companies outside the EU. That's the only way we can work. Otherwise, we shouldn't allow the money to flow to the British Virgin Islands or the Cayman Islands. So you choose. Besides the political process, it's not up to the Commission, right? The preparatory work by the Commission is flawless, but it comes into the political process where it's been torn apart. I'm not sure why Turkey is still on the grey list. I can't explain it. Benjamin maybe, but I'm not sure he's allowed to do that in public. So no, this process is a nightmare also. But I still think why the blacklist is very important in fighting these kind of constructions in offshore tax havens. Now the fifth subcommittee is still making up its mind what we need to do with the Pandora Papers. Several issues have come up, of course, the offshore tax havens and the blacklist. We also want to look into the enablers, and I think that's an important discussion. It was also touched upon in the introduction. We see a huge distinction between countries that have so-called a liberal regime and ones that have a regulated regime. I see at least an important distinction, and we need to definitely look into that. But also, I was surprised to see, by the way, I had to look up South Dakota. I didn't have the map of the US in my mind. Okay, this is in the middle of nowhere, but all of a sudden South Dakota has taken over Delaware. And it was just, and I think also other states like Texas. So we also need to look into what's happening in the US within our, similar like we have in Europe, we have our problems in our own house. Luxembourg, the Netherlands, Ireland, Malta, Cyprus. The European Parliament is the only institution that dares to call a spade, right? But we have also the same problems in the US. And this is what we also need to tackle. And this is exactly where the role from the subcommittee in. We say things that other people in Brussels cannot say or do not dare to say. So this is our job ahead. But like I said, more practically, we have to still to look what the ramifications are from the Pandora Papers for our work in the subcommittee.
And on tackling the abusive use of shell companies, I'm still not clear what kind of provisions you could come up with, like not forbid it or have transparency requirements. What exactly does the Commission have in mind?
I will not describe all the details. Obviously, you will have to wait a bit for the proposal. But the idea, basically, in two sentences, is to have a set of tests on the companies, which, if not met, could lead to the conclusion by the member state where the entity is located that this entity is a shell. The effect could be that this entity loses its residence certificate. So we do not ban the shell company, but if you have, for instance, a company, let's say a shell company, I'll take a completely neutral example, a shell company in France created by a German group, and the French authority concludes that it's a shell, then the German authorities could tax it as if it was in Germany, if it is no longer considered as resident. So that is the philosophy that we're using in our construction, a philosophy that does not prevent groups to organize themselves the way they want, but if there is a structure which is there only for tax reason, then we would neutralize the tax effect.
So when you say test, you mean substance, economic substance test, then? Number of employees?
I will not enter into the detail of the test because we are still working on it, but there will be an economic substance test. And I must say, since we have been talking of the blacklist, that's the only area today where our message is inconsistent. Because so far we say to all third countries, we do not impose rule to you that we do not impose on ourselves. But actually, at least for zero tax jurisdiction, we do impose economic substance rule. And there is no rule today on economic substance in the European Union at EU level. So we need to fill a gap, but to do it in a smart way. And I must say it's a difficult exercise, to be honest, for drafting, because we need to strike a complex balance. From a tax administration point of view, the easiest would be to have some kind of tick-the-box exercise. You know, you select 6, 7 criteria, they are met, not met, they are not met, shall turn the page. From a company point of view, you need as much fine-tuning as possible to take into account the specificity of the company and why the structure is there. But you cannot expect tax administration to take a case-by-case decision on 100,000 companies. It's just too burdensome. So we have to find the right balance. We are consulting a lot at the moment. We have many bilateral discussion with member state and also some business association. And as I said, we need now to complement the approach that we are working on for the European Union with an approach that integrates the lessons of Pandora, which add an extra level of challenge for us. So be a bit more patient. In December, normally, unless there is a delay, we will add this Christmas present at the bottom of your tree.
And you mentioned wealthy individuals, and it's true that we had the Anti-Tax Avoidance Directive, which was directed at companies, and Administrative Cooperation Directive, DAC 8, I think we are now. I mean, is there any ground for the EU to act on wealthy individuals, or is it harder than on companies? Do we have competences?
It's politically harder, but it's not that we are in a completely uncharted territory either, because you mentioned the DAX, and since we are among tax experts, I guess people know what the DAX are. There are some exchange of information, for instance, on bank accounts, which is only used for personal income taxation, not for corporate income tax. I referred earlier to OpenLux. OpenLux actually has shown a big misuse of shell companies by rich people. You had thousands, for instance, of shell companies established in Luxembourg by rich French people, which had only one asset, a castle, a yacht, etc., which was there clearly to escape taxation. So we try in our approach to cover not only shell companies created by businesses, but also shell companies created by rich people which are trying to escape taxation, because we want tax fairness.
Mm-hmm. And maybe to Aurore, with the anti-money laundering rules and the transparency on beneficial ownership, I mean, has we seen any changes in the way private individuals can hide their wealth offshore?
We are seeing also that there are a lot of private individuals that which are trying to repatriate their funds from a foreign structure. Yeah, and in Belgium, I would say, it's not easy because that's not the word, but there is a procedure for the moment to regularize people. So there we have a solution, so to say. But it's a big issue for the moment. But we see a lot of people trying to repatriate funds to Belgian bank and to liquidate all those kind of structure, and to regularize the situation with the Belgian tax authorities. That's what happened in Belgium. I don't know how it happens in the other country, but CRS has brought a lot of information to tax authorities, which are starting to look at that information, not always in the most adequate way, but at least they are trying to use it. And we see more and more tax audit with respect to individuals, and this is making the consequence of that is that also I think the behavior of the people is changing, and I'm wondering to what extent those Pandora Papers are not, at the end of the day, either people with something else to hide, like politicians, they don't want to see that they are rich, they don't want to see that they have some estate, okay, that's one thing. But I'm wondering to what extent these are not the old structure that we are now discovering, but today I don't have the impression, but that's my feeling, that we are still creating those kind of structure like we did maybe 20 or 30 years ago. There are definitely still people, but most of those people have sometimes other reason to do that than tax reason, and there is a tax advantage linked to it. Yeah. But I'm just wondering to what extent tax is still the main driver in that kind of structure.
And yeah.
It depends, I suppose, on the clients you have. What I find striking on the research into wealth that's hidden in tax havens, I remember a paper by Gabriel Zuckman and others, you don't talk about the 1%. You talk about the 1% of the 1%. So it's the Forbes 400. So are the 400 richest people in your country that has the main share of all these constructions. So it's not something. If you have a random sample, you won't encounter those people. So in that sense, I don't think there has been a huge change. I think people becoming more alert to it. But as long as we don't have this type of information and not the exchange of information, and there's no consequences, I don't see any reason why they would change. They've come there in the first place for financial reasons. The deterrent effect of the publications are not that large enough, I'm afraid. So we really need some good legislation to put pressure on it to really make it to make it change.
And I think it's DG FISMA who is working on the wealth registry, where you should put real estate and work of art and something. Do you think that this could be a way forward to have this?
Absolutely, we need to know who owns what. Otherwise, it won't work, right? And this is clear also from the Pandora Papers. It's a perfect way to hide wealth for whatever reason there is. Like it's criminals and politicians and the very wealthy, like Shakira, celebrities like Shakira, next to each other. So there are different reasons, but there are still perfect ways to hide wealth. And there are, of course, also new opportunities. We have the free port in Luxembourg. I'm not sure what's in the folds there, but I assume the tax administrations in Luxembourg and other European countries know what it is, and they should know.
Did you have something to add, Aurore?
Yeah, about that register, I never see a lot of information about it, so maybe you can clarify. But I was wondering, when I look into it, we have already, I don't know which DAC it is, but DAC 2, I think, when you have to exchange information on real estate and real estate income. So we have already something, we have already instrument, and crypto money is coming with DAC. I don't know. So my question is, DAC 2, there should be an exchange of information on...
But is it working well? Does it work? That's a question to you.
I don't know. No.
But I'm wondering, and maybe we'll open the floor to a question from the audience as well, but maybe to Benjamin, and wealthy individuals and transparency on what they own and so on. At some point, do you have any issues with GDPR? Because I'm guessing that it changed something in the fight also against tax avoidance, no?
When Shakira doesn't have only good tax advisors, it had also good tax lawyers and made our life a bit more complicated in Luxembourg. Yeah, we have to keep GDPR constantly on our radar screen. There's a discussion ongoing on the modalities of exchanging information and how it fits with the GDPR, etc. It's a balance to be found. I think there is also a major public interest in making sure that government can fight tax evasion. At the same time, data protection is mentioned in the Charter of Human Rights. So it has constitutional nature, and where to put the line is where very often the views diverge. As tax administration, by definition, we would like as much exchange as possible, and sometimes what we would like would be perceived by data protection experts as too intrusive. So it's a continuous adjustment process. That's the only thing I can say.
Okay, now we will. We have 10 minutes for questions from the audience, if there is any. There's a gentleman in the back. I don't know. Yeah. Okay, you have a mic.
Hi, Matt Thompson, Law 360. I'm a reporter, by the way. So my question is directed at Benjamin. It would be, if I was to place a bet on the digital levy being some kind of top-up of VAT, whether on retail or ad sales, what kind of odds would you give me? Is that likely from the Commission?
Sorry, I didn't hear your question correctly. Can you speak louder?
The digital levy being some kind of mechanism involving VAT, a top-up of VAT, is that likely or not?
You mean a digital levy like an online transaction tax, which would be on top of VAT? Well, some states are considering it. You have, for the moment, a discussion in the United Kingdom on whether to create an online tax on top of their digital service tax. Obviously, they will have to take a decision also on the digital service tax because of the OECD agreement. But as I said at the beginning of this intervention, the Commission is still thinking of what it will put in its own resource decision, and any comment from my side would be highly premature.
Yes, there's a gentleman here, maybe first. I don't know who was first, but I saw you first, so.
Thank you so much. Well, I'm Nasser, Brussels Police and City Councillor, and I thank you very much for giving us information for our new tax system and its impact on international and European level. My question is for Mr. Paul. Sir, you just said that 15% corporate tax companies will pay. Will they pay where they are situated, where they have their headquarters, or they will pay as well where they are operating it? Thank you.
Well, my first inclination is to say where the headquarters operated. That is the basis of Pillar 2. But then again, we have some form of a destination principle in Pillar 1. So that's the good news. But the discussion on who gets the revenue, because it will bring forward substantial revenue, the main allocation will be to the, let's say, to the rich and developed countries, right? So that's part of the discussion. I haven't seen any calculations on what the effect is of the last changes, because it has been changed somewhat in the favor of the G24. Then again, I think it's predominantly going to the rich and developed countries.
Thank you.
I'm happy to be correct.
Yes, please.
My name is...
Well, honestly, I think all estimates of the impact of Pillar 2 have to be taken with a huge pinch of salt. You can do static calculations, so you look at, for instance, what the corporate income tax is, let's say in Ireland, and you say, okay, you move from 12.5 to 15 for companies, and or you get extra income. But the static calculation ignore completely the fact that economy is a living animal, and by definition, the fact that some countries will increase the tax rate will have also impact on the behavior of the companies themselves. B, how can you disentangle the driver of competitiveness for some economies? Do you really think, for instance, that in Ireland, having, to keep this example, having the corporate income tax moving from 12.5 to 15 for some largest company changes dramatically the attractiveness of Ireland, which is a very open economy with a good labor force, flexible labor market, use of English, etc. Very difficult to say, honestly. No one has a clue, not even the Irish authorities. I would think personally that Ireland remains, with or without it, a very attractive and dynamic economy. Then you have the increase of the income indeed for the countries where the ultimate parent entity is, the seat country. But the way Pillar 2 is constructed is supposed to be a short-lived effect. Pillar 2 is not here to maximize the income of countries with ultimate parent entity. It's here, as Paul explained at the beginning, to push the other to increase their tax rate. The minute they do it, you start receiving far less income in countries having the ultimate parent entity. So the effect is unclear, and that was a positive element in the negotiation. In any international negotiation, you need what economists call a veil of uncertainty. If you have very clear winners and very clear losers, good luck for having the very clear losers on board. Here we have 136 countries that agreed on a dynamic process, which is very much a blank page, and that makes it interesting.
I have a question concerning the role of our profession. My name is Michael Schick from the German Federal Chamber of Tax Advisors. Maybe to Paul Tang first. As we are organizations who promote professional regulation and regulated professions. Now, where do you see the role of our professions, since we are a bridge between the client or between the taxpayer and the tax administration, concerning the idea Philippe Araou mentioned in his speech, compliance, and also preventing tax evasion and tax fraud? Since what we observe in the European Union, that the level of regulation is very diverse and very heterogeneous. Thank you.
It's for me or?
Yes.
Yeah. I can only agree with you. This is the the difficult part of it, even if all those evolutions, let's be very honest, are very good in the principle. This is very complex to manage from a compliance perspective, to help a client to be compliant, to make sure that there won't be any problem. That's really difficult. And what we see also, it's a high increase of tax controversy with a different administration, because there is a lot of information which are exchanged. Okay, that's good, but then the way the tax administration are using them, etc., it's not always fine, and they are not understanding very well what's going on. They are receiving actually too much information, and they are not able to study it properly. Or what we miss sometimes, it's that they use it. They directly send you a tax auditor or something. But you see that if they would first start with a request of information and asking further information, and maybe build the file progressively and not aggressively, I would say that would be much better. So indeed, and what is also very difficult to manage, I think, it's you have regulation of your domestic market, and then you have a layer from Europe, and now you will have a layer from the OECD or convention and whatever. So it's and the difficulty is also that, and we see that with DAC 6, I think it's you have different interpretation in the various countries. Because if you have a regulation which is international, you will have different interpretation depending on the countries, and this will make our life as a tax advisor, especially when you have cross-border transaction and that kind of thing, much more difficult. And there are the worst thing, I think, for taxpayer and for tax advisor is not complexity. We can deal with it. We are in a digital world. Things are changing, and complexity is not that so much the problem. It's uncertainty. And that's the biggest issue today. And I think, the fact that the tax controversy is increasing while the clients are most of the time thinking, yeah, I'm doing well, I'm trying to be compliant, I'm not doing any tax optimization, and I have never had so much tax audit in my life. So, no, but it's a bit, I don't know if it's, you have the same concern, and so, no, I will maybe share the mic with my...
No, in general, I try to already to express that the Pandora Papers shows for me that we very much look into all the enablers, the taxifier, tax accountant, lawyers, which are used by many people for different reasons, but including the criminals. So it goes also to the AML directives. And what I very much like in the ETAF work is that you strike a balance between the interests of the private clients and the public role that the tax advisors have to play. And I think that balance is important. That's not obvious. You need to find it, you need to discuss it, and then to find it. But there must be some balance in there between the public and the private interest. And that is clearly lacking in some of the countries where it's the interest of the clients that is predominant. Well, it's what the clients ask for. If the client says so, we can't. This is very much related to the ESG finance. If the client really, you can do whatever kind of reporting. If it's profits they want, if it's the return they want, it's the return they get. So that's how the world still works. And I think what we need to have is structural changes, like legislation on shell companies, improved blacklist, and all the structural measures we need to take to come at a fair and efficient tax system, and at the same time have a different role of, let's say, the tax advisors in a broader sense, including lawyers and accountants, to arrive at a cultural change that you need to balance private and public. So it's the structural and the cultural change that we need to aim for.
I'm afraid that we won't have more time for questions. I wish we had, because there's rain outside, and I mean we could keep talking about this for an hour. So I'm thanking all the panelists and ETAF for organizing, and I'm giving back the floor to Philippe Araou, who is going to conclude this event.
Well, let me begin by thanking the speakers for their very insightful contribution, and I propose a big applause to all of them. Thank you. During my opening speech, I said that with this conference, we wanted to launch a debate on what the post-pandemic tax world will be, if it will really be a fair one, and what role will tax advisors play in it. And well, I think that we got a good overview of what fair taxation could be and should be. It's clear that tax advisors have a role and a responsibility to help lawmakers to fight tax evasion and avoidance. And some of the lessons I have learned myself with this debate, well, it was very much interesting to hear each of you, including you, Elodie, because each one has a different profile and a different point of view, but it was very much complementary and even quite unified sometimes. So we learned from Benjamin that transposition of the OECD agreements by Commission will be done as soon as possible. So we are confident with this as soon as possible, and we look forward for that. Paul said that 15% of corporate tax may be not enough, but it is a big change compared to zero, and that is a change. And Benjamin said that even compared to 1/3 of member states, which are below that level. So this is absolutely a big change, and we were looking for that since many years. And well, we learned from overall that it would be easier for tax advisors to advise without tax havens, so it's good to know. And everyone advocates in favor of deleting tax havens. Let's wait and see how long it will take. But we are on the right lane today. So what is quite new and full of perspective is that taxation today is part of the public policy of businesses. This is a matter of responsibility and of inclusion as well. And of course, it serves the image and the reputation of the business. But this is absolutely new, and it is full of perspective. So Benjamin, thank you for the Christmas present at the bottom of the tree. we wait for that at the end of the year. And well, it is a particular moment for taxation in the world, not only in the EU, but in the world. And it is very, very much interesting for everybody, tax advisors, but not only, and for the business as well. And we look forward for what will happen in the coming weeks and months, and it's full of perspective. So it's quite exciting. So thank you, all of you. Thank you for the people connected online. And now I propose to have a glass together at the end of the room. Thank you very much.